Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we take a look at emerging markets. Emerging market investing brings its own unique set of challenges, such as corporate governance, state-owned enterprises, and stock markets, which are more closely linked with economic health, to name a few. In this month's podcast, we take a closer look at the opportunities and risks offered by these heterogeneous group of countries, and whether you should be adding exposure to your portfolio. Let's begin with China. Investor confidence in China has improved in 2017, but does this mean the outlook has too? Charlie Awdry, manager of the Janus Henderson China Opportunities, has seen investor euphoria and hatred in this decade of running funds. He talks to our senior editor from Morningstar.co.uk, Emma Wall, on what investors can expect next.
Hello, Charlie.
Hi, Emma.
So China seems to be doing pretty well so far this year, and indeed sentiment around the region has improved among investors, because not that long ago it was a kind of avoid, beware region, wasn't it? So have the fears gone away for a reason, or is it just about managing them?
I think the fears are still there. Obviously, China grabs a lot of headlines. And with things like a large amount of debt and slower growth, then, it's quite easy to get a scare response. But I think to that extent, actually, some of the fears have gone away because growth has been more rapid than people thought. What we're trying to say to people is, look, we know that growth is going to be slower now than it has in the past. And unfortunately, the debt situation is not going away. But please have a look underneath and see what's happening in the economy below those headline figures. And, you might see some good signs.
We're constantly told in developed markets that economics and stock markets are uncorrelated, partly because if you have a look at something like the FTSE 100, 70% of revenues come from overseas. That's less so the case in emerging markets, isn't it? But I believe there are some companies in China where actually what goes on with the economy is not necessarily has an impact on revenue and on stock prices.
Yeah, oh yes, absolutely. One of the things that we would do to show to clients is show the general trend of economic activity, maybe a PMI survey of manufacturing activity, which goes up and down, and at the same time show them, the net profit of an internet company or a Macau casino company or a car company. And you can see that basically because consumers have rising incomes and choose to spend it, these companies have, quite good outlooks or have delivered quite good profits in the past. So yeah, absolutely. There's a lot of companies that really don't mind what the PMI is, or whether GDP is 6 or 7, or whether there's a lot of debt.
But investor sentiment does, of course, move markets. It is looking more positive now. What do you think is the inflection for that? Why are people considering China again? Yeah,
good point. I've run this fund for 11 years. And in that time, I've seen investor euphoria, which was, exhilarating at the time, looking back quite scary. Then seen total disbelief and hatred towards the asset class. And I'd say what we're in now is a kind of not sure, almost forgotten about. And of course, that's quite a good starting point for investment. And I think people are suddenly now saying, well, okay, so you can generate some returns in China. That's interesting. How are you doing it? And related back to your questions about slower growth. But what I think would be really interesting for us as an asset class is if China continues to outperform and goes up when developed markets fall. Because up until now, it's been very easy for a lot of clients to say, Charlie, thank you, that's very interesting, but I like my Facebook shares or I like my Amazon shares or whatever. Now, if those shares happen to fall and China outperforms, then that's much more difficult answer. And in fact, we all know generally that flow follows performance. So if we outperform on a relative basis, then I think that could be very interesting.
Now, over the last month, there have been two things that have happened within the sort of investment world that have affected China. One of them is China A inclusion in MSCI. So, ETF investors are being forced to buy more China shares. And the other one was news this week that there's going to be a bond connect between the China market and other international markets. Both of those, I suppose, bring China assets, equities and bonds to the individual investor in a more accessible way, which I presume is a positive thing for investors.
It's a positive thing for investors if they want to embrace China. I know many people, having talked to lots of clients, who don't, and that's absolutely fine, and they may have some issues. But certainly I would see it as with more foreign money coming in, there will be an accelerated interaction between foreign investors and Chinese companies. And I think the more that happens, the more that corporate governance can be taken forward and improved from a low base, and therefore I think that improves the outlook for those investors. But it's going to be very small. I think by August next year, 2018, it will be 0.73% of MSCI emerging markets. It's very small. Active managers like ourselves, we already have more than 10% of our funds in a very, very small subset of that. And I think that's the exciting aspect for active managers, that people who have ignored China previously, this might be their catalyst to go there, to the mainland markets, and they might be surprised to see some of the quality companies there. Not all of them, but a very small subset are very good companies.
Charlie, thank you very much.
How does China impact emerging market investing? China is the largest economy in Asia. How does the Chinese economy impact investing in the rest of the region? We talked to Gary Greenberg, manager of the Hermes Global Emerging Markets Fund.
Hello, Gary.
Hi.
So we're running a special Emerging Markets Week this week, and today we are focusing on China. Now, I know, of course, you are a Global Emerging Markets Fund Manager, which means you get the pick of that sector. But I wanted to ask, as you do have a large allocation to Asia, how much is China the dominant player in that region? Do you have to consider China with every investment you make?
Well, you have to consider digital disruption with every investment you make. And China does have some of the companies that are really at the forefront of that, especially Alibaba. And Alibaba is expanding outside of China. So in that sense, yes, there is that factor. But actually, if you look in India, for example, there are many companies that aren't really affected at all, especially in services. And so really, bottom up, you can look at companies anywhere in Asia that may or may not have any real effect.
And so I think Asia, probably in the past, those smaller countries that were very dependent on China, is that fair to say? But now the region is more heterogeneous and they are standing on their own, both as an economy but also with equities.
Yeah, you've got a lot of companies in Asian markets that have gone global. Taiwan Semiconductor, for example, is a global company. Some Indian industrials such as Motherson Sumi, Tata Motors, Bharat Forge are global companies. So especially with Indian companies, but also with some others, the language is no barrier. People travel all over the world. Supply chains are global. So it's really one interconnected world.
Looking at the sort of economic health of Asia, again, does China sort of dominate that? Because there were, although they seem to have eased off, some concerns about Chinese growth and Chinese debt levels. Does that have a ripple effect through the region?
It has a ripple effect on some countries. Korea and Taiwan are particularly exposed to Chinese growth. Indonesia also through the commodities. Having said that, I think it's fairly clear that China will continue to slow, but it's such a large economy that even slow growth for a $10 trillion economy is substantial. And so if the countries that are economically dependent, we'll see a gradually slowing source of pull for their exports, but nothing traumatic. We don't expect China to come to a hard stop, and we don't expect the debt situation to come to an explosive denouement anytime in the next year or two.
Looking then at your portfolio, where are you seeing the greatest opportunities? I know you're a stock picker, but are there any particular countries that, because of the macro, are really standing out for you in Asia?
Actually, right now, everything is sort of gradually slowing in Asia. India needs to recapitalize its public sector banks to get a real cyclical upturn. That's not happening yet. Taiwan and Korea are globally exposed, and as I mentioned, exposed to China, which is slowing a bit. Indonesia is a big commodity exporter. However, even though that's slowing, nevertheless, domestic demand in Indonesia is keeping the growth rate pretty decent. So overall, things look steady, things look relatively calm, with the exception of North Korea. And it's really, sorry to say, it's really more on picking stocks.
Gary, thank you very much.
What are the risks associated with investing with emerging market bonds? And what do they add to an investor's portfolio? We talk next to Morningstar Investment Management's Tanguy de Luzon on how best to add emerging market bonds to your portfolio.
Hello, Tanguy.
Hello, Emma.
So today we're talking about emerging market bonds. Firstly, I wanted to ask, what is the appeal of this asset class?
Well, it's an asset class that's quite appealing. So you've got two sections of that asset class. So EM debt issued in hard currency, so in dollar terms. So you got a spread on that, and typically because those markets have lower quality, you got good spread. So it's a way to enhance your returns while still having exposure to the US curve principally. And then on the other side, you've got the emerging market debt issued in local currency, and then you typically have pretty high yields due to the higher inflation, but also to the premium that are requested by investors to invest in those countries.
And of course, in developed markets over the last 10 years, we have seen such record low yields that income investors, it's not surprising they've looked overseas to try and get a real return on their money. But there are risks associated with EMD, aren't there? Yeah,
definitely. So, effectively, investors have searched for yield, so, went very much into those asset classes, but there are definitely, significant risks. So here, hard currency, effectively, you could see at something similar to high yield, where, you are offered a high yield or high credit spread, but it is because the credit quality behind that is pretty high. And on the local currency side, obviously, you've got the currency risks. And so when everything goes well, that's potentially a contributor to returns. But when market sentiment turns down, or when you have issues at the sort of sovereign health, then obviously the currencies can swing pretty heavily the wrong direction, making that investment very risky.
And is it fair to say that default rates in emerging markets are much higher than those in developed markets?
Yeah, it is true, definitely. We've seen a few of those countries, defaulting of their debts. You can think of, LATAM countries. We've had quite a few issues over the past years. So it's definitely something to consider.
And with any investment, of course, you've got to weigh up the risks and the rewards. So how can you use emerging market debt in your portfolio?
So typically, we see emerging market debt as sort of an hybrid type of investment, with, sort of income characteristics that are very appealing, especially for defensive portfolios, but also, keeping in mind those risks that are elevated. So we see it as a good way to diversify your sort of growth investment. So slightly less risky than equities, but definitely more risky than bonds. And so those hybrid characteristics, when the evaluations are attractive, are effectively a very good way to enhance the risk reward of your portfolio.
And emerging market debt carries a higher yield than developed market debt at the moment, but it has come down, hasn't it? Much like the bond rally we've seen in the US, Europe, and the UK, yields are much lower now than they were a couple of years ago.
Yeah, so I think generally the health of many emerging markets have improved over the last few years. This has been recognized by investors. So we've seen yields coming down significantly. So close to 1% since the beginning of the year on local debt. Spreads on the hard side have come down from over 400 basis points to now close to 300 basis points. So definitely a reduction in the yield offered by those markets, making them effectively less appealing now.
And of course, you operate a value-based investment strategy. So presumably this makes them less attractive to you now than they were a year ago, 2 years ago.
Yeah, we're quite excited by those markets a year ago, and now we see, the attractiveness has decreased significantly, mostly on the hard currency side, effectively, where spreads are now below what we consider a fair value, and so we don't really feel we're paid for the risk, or we were talking about default risk that we're taking. On the EM local side, the yields are still reasonably appealing, but on the currency side, so currency is obviously a big portion of the risk you carry with those, and at the moment, especially with the pound, being at reasonably cheap levels, this is not something that's likely to offer positive return in the future, and definitely carries some risk. So this is definitely an asset class that we find less and less attractive.
Tanguy, thank you very much.
You're welcome.
Currency depreciation can have a very negative impact on the balance sheets of sovereign bonds and of corporates, but it can create investment opportunities too. Joining us next is Claudia Kalic, manager of the M&G Emerging Markets Bond Fund, to explain how currency impacts emerging market bond investing.
Hello, Claudia.
Hi, Emma.
So I know in the last 6 months you have moved some of the portfolio more into local currency issued bonds, but I thought we could take a step back and ask, what does currency mean for a fixed income investor, and how does that play into your investment strategy?
Yeah, so currencies is quite important for emerging market investing for a couple of reasons. One is the currencies, particularly if you have an abrupt depreciation, could have very negative impact on balance sheets of sovereigns, of corporates, particularly if they happen to be very highly leveraged. and of course the currency that they depend most of their revenues depreciate. So that's more from a credit standpoint that I would look at. The other aspect is really the investing in local currency instruments, bonds or currencies themselves. So this opens up another gamut of opportunities. And as you highlighted, I have actually increased the exposure to local currency instruments, which is about a third of the fund at the moment from as low as 10% about 2 years ago. And this is much predicated on the risk-reward, the opportunities of those currencies, and primarily with the view that we've seen a very large, finally, a real depreciation of those currencies a couple of years ago, and also the imbalances that a lot of those countries suffered, particularly large current account balances, is starting to shrink. So that should also be supportive for those currencies going forward.
Bottom line, does that mean that you are feeling more positive about the economic outlook for those countries? Because, of course, when a country's economy does well, then its currency has strength.
Correct. So the economic outlook is one way of looking at it. The other one is also monetary policy and inflation pattern in those countries. So for a local currency bond, of course, currency is one component of returns, but one should not also overlook the interest rate component. And in that case, we've seen quite a bit of inflation peaking in a lot of countries that had very large currency depreciations a few years ago. So countries like Russia, Colombia, Brazil, and so forth. So inflation is at the peak, which means the central banks have already embarked on an easing monetary stance, which is quite different from what we're seeing in Eastern Europe, and of course the major central banks, the ECB and the Fed. So this also gives very good uncorrelated opportunities in this subsect of the asset class.
So you mentioned a couple of countries there, but perhaps you could highlight somewhere you see you have real conviction, something that you are very positive on at the moment.
Yeah, so within the currency space, we're highlighting a couple very idiosyncratic plays. So, for example, Egypt pound, which arguably is not the most liquid currency out there, but the Egyptian central bank finally allowed the currency to depreciate. And recently, even last night, they also tightened rates further because the inflation is still rising. So that should be quite supportive for those local currency bonds. In terms of more mainstream countries, Russia bonds, I think, are still attractive. The central bank has been quite still hawkish, and they've been basically removing the monetary policy stance very, very slowly. There is also opportunities, however, in the hard currency space. So 2/3 of the portfolio is still within hard currency bonds. So in that respect, we see opportunities in pockets of Eastern European countries that are benefiting from the recovery that we've seen in the Eurozone. Some of the weaker countries, such as Albania, Macedonia, really exotic type of countries, usually tend to be underlooked by investors. So we find pockets of value there. And the other areas, also pockets within Central America, Caribbean, similar regions that when we spoke 2 years ago, I also mentioned those regions. And this shows that, in some of these cases, you have to look at those countries for the long haul. So same countries that I was invested 2 years ago, in some cases, I still have the holdings at the moment.
Claudia, thank you very much.
Thank you, Emma.
With economic growth in the Eurozone, there is an increased demand for manufactured goods, materials and energy, all provided by Eastern Europe. Chris Kalunga, manager of the BlackRock Emerging Europe Trust, is up next to discuss some interesting emerging Europe opportunities.
Hello, Chris.
Good morning.
So we're running an Emerging Markets Week this week, and today we are focusing on emerging Europe. One of the questions I wanted to ask you is that actually we have seen great growth in the Eurozone, and we've seen a return to favour European equities among retail investors. And I was wondering, how much does that impact, positively or negatively, emerging Europe going east?
Well, as you can imagine, it has quite a significant impact for multiple reasons. One being that clearly with growth in the Eurozone, you would expect an increased demand for manufactured goods, materials, energy, and these are all things that Eastern Europe tends to provide for Western Europe, given the lower wage growth and in many cases higher productivity than their Western peers. So as a result, you kind of get this pull of demand and an increase in growth within Eastern Europe. And on top of that, you have a second layer. And one is, with the ECB starting to tighten rates, given how interlinked these economies are, you have a situation where the Eastern European banks, where all of those economies are already growing faster than Western Europe, need to start to raise their rates as well. And what this will allow is the banks to start having slightly higher margins going forward. So for the last 8 years, we've been talking in Europe about negative rates, slowdown in loan growth, slowdown in economies. As Europe accelerates, Eastern Europe accelerates even faster. They've already got underlying growth. coupled with the story in the rates, you could see significant re-ratings in those banks, especially in Eastern Europe, especially to their relative peers in Western Europe.
And of course, we are grouping all those countries together for that particular point, but they are a heterogeneous group. What are the other drivers of Eastern emerging Europe?
Well, you got a couple different, and I guess I should distinguish here, especially when we're talking about Central and Eastern Europe. You know, Poland, Hungary, Czech, Romania. These are the guys that are really plugged in to Eastern Europe. You still get a benefit out of Greece, out of Turkey, out of Russia from what's going on to Europe, but that leverage really comes in the Eastern CE4 bloc, if you will. The other drivers there, though, is that these economies are still playing catch-up with Western Europe. You're still seeing significant investment into their infrastructure, increases in their productivity, and many of the governments have been able to run fiscal policy that is actually very helpful for the consumer. So Poland, for example, has enacted a lot of fiscal spend recently that benefits the consumer directly, putting increased money in the lower the lower mass segment pocket, which increases the consumer spend within Poland, accelerates the economy even faster. And this is happening not just in Poland, but in Hungary and to a lesser degree in Czech and Romania.
But one of the things that is, on the negatives that's levied against this bloc, though, is that they are more volatile than Western Europe, partly because the stock markets are made up of more cyclical sectors. Do you think that's a fair accusation?
We need to be careful when we say that about distinguishing which countries we're talking about. Some are naturally more volatile than others. You know, Russia, Turkey do have a higher volatility, say, than Poland or Czech. But the thing within these economies, within this grouping, there's actually a greater diversification when the E7, as we call them, if we take those Central Eastern European, the CE4, add in Turkey, add in Russia, compare that with the G7, you've got such a greater diversification available to you, meaning that the markets move in their own ways and separate from each other. So whilst one or two countries may be extremely volatile, they don't tend to move in the same direction as the other economies at the same time. And so as an active manager, what we get to do is pick and choose where we think we're going to get the highest return for our investors. And that's something that this grouping really allows us to bring to the forefront.
Chris, thank you very much.
A pleasure.
Why is Russia an attractive investment opportunity? There are many risks associated with investing in Russian equities, but these have made the market cheap, and there are some very interesting stock opportunities, explains Morningstar Investment Management's Sariq Bourbon up next.
When looking at investment opportunities around the world in equities, we currently find Russian equities as the most attractive market. Russian equities has a lot of negatives attached to it, which obviously is one reason this market is quite cheap. However, there are quite a few positives when looking at the composition of the Russian market first and how it's evolved over time. For instance, although the energy sector still represents about half of the MSCI Russia index, the composition of that energy sector has changed dramatically compared to 10 years ago. Gazprom used to represent about 35% of the Russia index, and it now accounts for about 12-13%. A lot of other companies, other energy companies, which are high quality, have actually risen in the index. Worth highlighting as well, outside the kind of energy sector, Russia also has possibly one of the best banks globally in Sberbank. So there are some very interesting drivers that have evolved, making Russia definitely a more interesting place to invest now compared to 5, 10, 15 years ago. Finally, thinking about valuations of the market as a whole, on a simple rule of thumb basis, it appears that when a market trades on a dividend yield of about 5%, which is effectively roughly equal to its price to earnings ratio, this tends to be a good indicator for long-term investors. Acknowledging that there will be some volatility in the short term, but thinking about the upside to downside ratio, there is definitely a strong skew towards the kind of upside for this opportunity.
Staying with Russia, Liam Spillane, head of emerging market debt at Aviva Investors, says that Russian bonds are no longer good value, but there are pockets of value to be had in other areas of emerging Europe.
Hello, Liam.
Hello.
So we're running an emerging market week this week, and today we're concentrating on Russia and emerging Europe. And we've heard from some of your counterparts that Russia looks attractive on a valuation basis when it comes to equities. I was wondering, is the same true for fixed income?
Well, not today, not as much as it was. We'd make the argument that the valuation argument for fixed income for emerging market debt in Russia has materially changed in the last few months. That's particularly related to the policy objectives of the central bank and inflation. So there is still an attractiveness in fixed income for Russia, but not as attractive as it was a few months ago.
And if we move slightly further west into emerging and Eastern Europe, where are you seeing pockets of value or indeed individual cases which you think are attractive?
I think pockets of value is the right way to think about it. Certainly relative from a regional perspective to some of the other regions, Central and Eastern Europe isn't as attractive. But underneath that, we really like the Polish currency, the Polish zloty, and we particularly like the idea of higher rates in Czech Republic, which we're aware is a position that the market holds. We're not alone, it is somewhat consensus, but certainly those two markets are ones that we prefer.
And I suppose that is an important case worth making because unlike Western Europe, which is mostly dominated by Eurozone, of course, Eastern Europe and Central Europe, a lot of them have their own currency, and that really plays into fixed income investing.
Absolutely, yeah. I mean, very much a requirement for differentiation here. As we evolve through higher yields globally and we move into that cycle that we expect to happen over the coming quarters, the need for differentiation is quite important. And you're right, the currency is a particularly obvious differentiator for those countries. And
central banks in the West are expected to start raising interest rates soon. Some of them already have with the US. Is that the case also in Russia and emerging Europe?
I think the Russian cycle, rate cutting cycle, is probably coming to an end, or at least is well priced by the market now. There are, again, a need for differentiated views within Central and Eastern Europe. I mean, the Hungarian central bank is continuously dovish. The market has been waiting for the Polish central bank to become a little bit more hawkish and raise rates. But broadly speaking, there's not really a great deal happening there at the moment, albeit there are some underlying inflationary trends happening.
And you are, of course, head of emerging markets debt, so it does mean you can look across the world for investment opportunities. Where are you seeing the most compelling opportunities if they're not in Russia and emerging Europe?
Really, we're focusing most on those countries that have been able or willing to reform, financial reform, and those that have the most attractive valuation. So particularly we're looking at Indonesia, local bonds at the moment. We have an investment there, and also Mexico. There's been a lot of well-documented concerns around Mexico, but I think the long-term valuation argument there is very strong. And then looking at some of the other smaller countries, perhaps Peru, local government debt is one of our favoured markets as well.
The Mexico argument is quite interesting because a lot of people are going off the equities despite a positive performance because of the threat of Trump and the sanctions that he may introduce, the trade restrictions. But with fixed income, that's not a concern for you?
I think it is a concern, but it's a diminishing concern. If we take this back 6 months ago to post the US election, it was a very valid and present concern. But as we move forward and the Trump administration the world gets more familiar with the Trump administration, I think we still see that as a little bit of a concern, but not too much. And as I say, the long-term valuation attractiveness of Mexican assets kind of supersedes that now and gives us quite a high conviction in that market.
Liam, thank you very much.
Pleasure, thank you.
Finally, we return to Hermes Global Emerging Markets Fund Manager Gary Greenberg, who picks 3 emerging market companies he thinks are good for growth.
Hello, Gary.
Good morning.
So what's the first stock today?
I like Alibaba a lot. It's listed on the New York Stock Exchange. They're a giant in e-commerce, not only in China, but increasingly across Asia. Alibaba is really interesting because they have mastered big data and what it can do. And their ability to tailor product offerings to sell on their online malls and their ability to even tailor entertainment is really unmatched. It's becoming the Amazon of Asia.
But with added services as well, aren't there? I mean, Amazon started off just doing one thing, but Alibaba's moving into financial services. It's moving into social media. It's quite a juggernaut, isn't it?
It's a juggernaut, and they're able to use the artificial intelligence inherent in their system to make information available to all the different parts of their business. In particular, Alibaba's ability in financial services is such that they can make a loan without somebody filling out a form because they know so well what the person's going to do. Their money market fund, which is a subsidiary of Ant Financial, is now up to $200 billion. It's grown 100% in the last 6 months. So they're a very powerful company.
And what's the second stock today?
I like Sberbank. Sberbank is a very cheap stock. It's the dominant bank in Russia. It's trading at around 5 times earnings. Profitability is good. Management is strong. And Russia, although it's under sanctions, nevertheless may have an in with the U.S. government, so looking pretty good.
And what is the third stock today?
We like a company in Taiwan called Landmark Optoelectronics. It's a smaller tech company which makes light-emitting diodes. The point here is that they're able to transmit, to blink on and off 15 to 20 billion times a second, which basically gives the diode the ability to transmit data at an incredibly fast speed. They're working with Intel on this, and the outlook over the next year is very positive for this business.
And how dependent on Intel are they for that? Because we have seen some smaller tech companies go under, for example, when their Apple contract gets cancelled. Is this a diversified revenue stream?
Yeah, this is a technology which most people are going to need because the speed is important for 5G as it comes in, for Internet of Things, etc. So this is a technology which is universally applicable, and it's much faster than electricity, so it's much more efficient.
Gary,
it's the way it's going to go.
Gary, thank you very much.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.